It's a Tuesday night, 11:18 p.m. You're lying in bed, phone face up on your chest. Your banking app is open. $5,247. That number has sat there for 3 months, maybe 4. You keep meaning to do something with it. Move it somewhere. Make it work. But every time you open a browser tab and type how to invest, you close it 12 minutes later feeling more confused than when you started. So the money just sits. And inflation, quietly, invisibly, politely, eats it alive. That's where most people are. Not because they're bad with money. Not because they're lazy. But because nobody ever showed them a simple, boring, ugly system that actually works. Today, I'm going to show you that system. No day trading. No crypto bets. No hot stock tips from my uncle's neighbor's coworker. This is the unsexy way. The slow way. The way that turns $5,000 into $220,000 if you just leave it the hell alone. Let's get into it. Let me ask you something. Have you ever actually sat down and done the math on your time? You wake up at 7 a.m. You commute. You work 8 hours. You commute back. You cook, you scroll, you sleep. On a good day, you kept maybe 90 minutes for yourself. And in those 90 minutes, your money, that $5,000 sitting in a savings account, earned you roughly 64 cents. 64 cents. You gave 10 hours of your life to your employer today, and your money gave you 64 cents. Now I'm not here to make you angry, but I do want you to feel the imbalance of that, because that imbalance is exactly what this system is designed to fix. The entire philosophy behind what I'm going to teach you is this. Your money should eventually work harder than you do, not instead of you, in addition to you. You keep your job, you keep building your skills, but in the background, silently, your money is compounding. That's not glamorous. That's not going viral on social media. But that is exactly how ordinary people build extraordinary wealth. Here's a scene I want you to picture. Sarah is 29. She's got $5,000 saved. She knows she should invest it. She's read articles. She's watched videos. She's even downloaded 3 different investment apps. But the money is still in her checking account. Because every time she thinks about putting that money into the market, her brain generates a very specific fear. What if I lose it? And that fear is completely understandable. But it's also, and I say this respectfully, based on a misunderstanding of what risk actually means. Because here is what Sarah is not thinking about. Every single day she leaves that $5,000 in her bank account, she is already losing money. Just slowly, invisibly, without drama. Inflation in the US is running around 3.3%. Her savings account is earning maybe 1.9%. That is a net loss of 1.4% per year. Over 10 years? That $5,000 in the bank has the purchasing power of roughly $4,350. She didn't invest and lose money. She didn't invest and lost money. That is the trap. And we are going to dismantle it right now. Before I show you the actual system, we need to demolish 3 beliefs that are probably sitting in your head right now. Because if we don't clear these out, nothing else I say will stick. Myth 1, I need more money to start investing. You do not. $5,000 is not a small amount. It is a real starting point. People convince themselves they need $50,000 or $100,000 before investing counts. That is a lie you tell yourself when you are afraid to start. Here is the truth. The habit is worth more than the amount. Think about fitness. If you only have 10-pound dumbbells, do you skip the gym entirely? You build the habit, you learn the movement, and when you eventually get access to heavier weights, you are already trained. $5,000 is your 10-pound dumbbell. Use it. Myth 2. Investing means watching charts all day. For professional traders? Maybe. For you? Absolutely not. The entire concept behind what I'm teaching today is passive investing. That means you are not picking stocks. You are not reading earnings reports at midnight. You are not day trading from your phone on your lunch break. You are buying a tiny piece of everything through broad index funds, and then you are getting out of the way. The market over time goes up. You are not smarter than the market. I am not smarter than the market. Nobody watching this video is smarter than the market. Don't fight it. Just join it. Myth 3. The market is too risky right now. There is never a perfect time to invest. Never. In 2010, people said, the market just crashed, it's too risky. In 2015, people said, we're at an all-time high, it's going to crash. In 2020, people said, there's a pandemic. Too uncertain. In 2023, people said, inflation and rate hikes. Too volatile. The people who said, too risky in 2010 and waited, they missed one of the greatest bull runs in modern history. The best time to invest is not when things feel safe. It's when you have a system, because a system removes emotion from the equation entirely. And that system is exactly what we're about to build. I call this the 3-layer architecture. And before you panic, it is not complicated. It is almost embarrassingly simple, which is exactly the point. Here it is. 20% the safety net, $1,000. 60% the growth engine, $3,000. 20% the opportunity fund, $1,000. That's it. 3 buckets. 1 decision made once. Let me walk you through each one. Layer 1. The safety net, $1,000. This is not an investment. This is psychological armor. That $1,000 goes into a high-yield savings account or a short-term money market fund. Something liquid. Something you can access within 24 hours if your car breaks down, if you get a medical bill, if life does what life does. Why does this matter for your investments? Because the number one reason people blow up their portfolios isn't picking bad stocks. It's selling good stocks at the wrong time, because they had an emergency and needed cash. The safety net prevents that. It means your investment money is truly long-term money. You never have to touch it in a crisis. Think of it like a marathon. If you start the race by sprinting, you crash at mile 8. The $1,000 safety net is what keeps your pace steady for the full 26 miles. Layer 2, the growth engine, $3,000. This is the engine. This is where your wealth actually grows. $3,000 goes into a simple 2-part portfolio. 70%, $2,100, into broad stock market ETFs, something like VTI, VOO, or Vanguard's VT. These track the entire US, or even the global stock market. 30%, $900, into bond ETFs, investment-grade bonds that cushion you when the stock market drops. Why this split? Stocks provide the growth. Historically, a diversified stock portfolio returns between 8% and 10% annually over the long term. But it's bumpy. Some years you're up 25%. Some years you're down 30%. Bonds are the seatbelt. Lower returns, usually 3% to 5%, but when stocks fall, bonds tend to stay stable or even rise. That balance is what keeps you in the car when the road gets rough. Now, do not try to time this purchase perfectly. Nobody can. Not hedge funds, not billionaires, not the algorithms on Wall Street. Instead, use dollar cost averaging. Take that $3,000 and split it across 6 months. $500 per month. Every single month, regardless of what the market is doing, you buy your ETFs. This strategy automatically means you buy more shares when prices are low and fewer shares when prices are high. Simple. Mechanical. Effective. Layer 3, the Opportunity Fund, $1,000. This last $1,000 is your ammunition. Park it in a money market fund or a short-term treasury ETF, something earning 4% to 5% right now, and wait. Wait for what? For the market to drop more than 15% from its peak. When that happens, and it will happen because it always does, everyone else is panicking. They are selling. They are doom-scrolling financial headlines. And you? You are calmly deploying your ammunition. You are buying the same assets at a 15%, 20%, 30% discount. During the 2022 market pullback, investors who had cash ready and deployed it saw over 30% gains when the market rebounded in 2023. That $1,000 sitting idle in a money market fund is not idle. It is loaded. Now, how do you actually do this? 5 steps. Write them down. Step 1. Open a brokerage account today. not tomorrow, not next Monday when you have more time. Today, it takes 10 minutes. You need your ID and your bank account number. Pick a broker with low fees and a clean interface. Fidelity, Schwab, and Vanguard are all solid options. Most of them offer zero commission trading on ETFs now. 10 minutes. That is less time than you spent deciding what to watch on Netflix last night. Step 2. Set up automatic transfers. This is the single most powerful thing you can do. Set a recurring transfer from your paycheck to your brokerage account. Choose an amount you barely notice. Even $100 or $150 a month is more than enough to start. Why automatic? Because human nature will always find an excuse. I'll do it next month when things settle down. I'll wait until after the holidays. I'll wait until the market makes sense. Automation removes you from the decision. The money moves before you can talk yourself out of it. It is, quite literally, the financial equivalent of a washing machine. You set the cycle, press start, and walk away. Step 3. Pick your ETFs and stop overthinking. Any of these works. All of them are diversified. All of them have low expense ratios. All of them will, over time, reflect the growth of the broader economy. Do not spend 3 weeks researching which ETF is marginally better. The marginal difference is nothing compared to the cost of inaction. Pick one. Move on with your life. Step 4. Rebalance every 6 months. After 6 months, check your portfolio ratio. If stocks grew faster than bonds, your 70-30th split might have drifted to 80-20ths. Sell a little of your stocks. Buy a little more bonds. Bring it back to 70-30ths. This sounds counterintuitive. You are selling your winners and buying more of your laggards. But that is exactly what disciplined investing looks like. It forces you to buy low and sell high, automatically, without ever making an emotional decision. 30 minutes every 6 months. That is the total time commitment. Step 5. Learn but don't react. Spend 1 to 2 hours a month reading about markets and personal finance. Stay informed. Understand the macro picture. But do not check your portfolio every day. Do not react to every headline. Do not sell because someone on social media is scared. Here is a statistic worth remembering. The average retail investor underperforms the market by 3% to 5% per year, not because they picked bad stocks, but because they traded on emotion. The best investment strategy is the most boring one. Rebalance. Repeat. Now let's talk about what this actually produces. A 70-30 stock-to-bond portfolio has historically returned between 6% and 8% annually over the long term after accounting for inflation. Let us be conservative. Let us say 7%. You invest your $5,000 today. In 10 years, your initial $5,000 becomes $9,835. In 20 years, that same initial investment becomes $19,348. In 30 years, $38,061. Now, that alone is almost an 8x return on your original money. Without touching it, without thinking about it, without doing anything. But here is where it gets genuinely remarkable. If, on top of that $5,000, you automate just $150 per month, that's $5 a day, roughly what a mid-sized coffee costs, the picture changes entirely. In 10 years, approximately $31,000. In 20 years, approximately $96,000. In 30 years, just over $220,000. $220,000. From $5,000 and $150 a month. That is not magic. That is not a loophole. That is compound interest, running quietly in the background, doing the work your savings account never could. Einstein reportedly called compound interest the eighth wonder of the world. And he was not exaggerating. The math isn't complicated, but the patience required to let it play out? That is where most people fail. I have to tell you something real. When the market dropped in early 2020, and I mean dropped, we are talking 30% in about 5 weeks, I watched my portfolio lose a significant chunk of value on paper. And I want to be honest about what that feels like. It feels bad, even when you know it is temporary. Even when you have read every book and understand that market corrections are normal. Even when your rational brain is telling you, this is fine, this is fine, this is fine. There is a moment, usually at 1 a.m. when you check your app one more time, where you feel a very specific kind of dread. But I did not sell. Not because I was brave. Not because I am exceptional. But because I had a system. And the system told me, do nothing. The bonds in my portfolio were cushioning the fall. My emergency fund meant I did not need to liquidate investments for cash. My opportunity fund meant I could actually buy more at a discount. By the end of 2020, not only had the portfolio recovered, it was significantly above where it started. That experience taught me something I could not learn from any book. Your biggest enemy in investing is not the market. It is the 4 inches between your ears. A system is not just about maximizing returns. A system is what keeps you sane when everything feels like it is falling apart. It tells you exactly what to do, which is usually nothing. Here is something I want you to sit with. Your $5,000 is not the most important asset you have. You are. If you are 28 years old making $55,000 a year, and you work until 60, that is 32 years of income. That is $1.76 million in raw salary. And that does not count raises, promotions, side income, or career pivots. Your human capital, your ability to earn, learn, and grow, is worth more than any investment portfolio you will build in the next 5 years. So do not obsess over yields and returns to the point where you neglect the thing that generates everything else. Invest in your skills. Build your network. Take the course. Read the book. Chase the promotion. When your income grows, so does the amount you can invest. And when the amount you invest grows, the compounding accelerates. A friend of mine started this exact system with $5,000 at 26. But at the same time, he also committed to leveling up his career, took on harder projects, built expertise in a niche, made himself undeniable. By 34, his income had nearly doubled, which meant his monthly investment contribution had tripled. He is 38 now. His portfolio just crossed $180,000. Not because he was brilliant, not because he had special access, because he built a system, stayed consistent, and invested in himself as aggressively as he invested in the market. Let me bring this home. Here is the full $5,000 unsexy system one more time. $1,000, 20%, safety net. High yield savings or money market. Liquid. Untouched. $3,000, 60%, growth engine 0.70% broad stock ETFs, 30% bond ETFs. Dollar cost average over 6 months. $1,000, 20%, opportunity fund. Parked in a short-term ETF. Deployed when the market drops 15% or more. 1. Open a brokerage account, today, not someday. 2. Automate transfers, even $150 a month makes the math work. 3. Pick simple ETFs, VTI, THO, V. Stop overthinking. 4. Rebalance every 6 months, 30 minutes of discipline, twice a year. 5. Learn continuously but react to nothing. Do this consistently for 30 years and your $5,000 grows to over $220,000. That is not a fantasy. That is arithmetic. I want to leave you with something that has nothing to do with numbers. The person who builds this system, who opens the account, automates the transfers, rebalances twice a year, and doesn't flinch during crashes, is not just building wealth. They are becoming someone different. They are becoming the person who thinks in decades instead of quarters. The person who doesn't need instant results to stay motivated. The person who trusts systems more than feelings. That identity shift, from short-term reactor to long-term builder, is worth more than any single financial decision you will ever make. And it starts with $5,000. Not perfectly invested. Not perfectly timed. Just invested. Here is what I need you to do tonight. Not next week. Tonight. Spend 30 minutes looking up how to open a brokerage account. Write down your current assets, checking, savings, everything. Decide how much you can automate each month. That is it. 30 minutes. The version of you that exists 10 years from now is being shaped by the decisions you make in the next 30 minutes. And I promise you, that version of you will not care what the market did in 2026. They will only care that you started. The best time to plant a tree was 20 years ago. The second best time is right now. Go build the system. If this helped you see money differently, not as a number, but as a system, subscribe. More of this. Less noise.